Welcome to Chapter 2, How Mutual Funds Work. To a shareholder, a fund can look almost effortless. Submit an order, receive shares, and later see one net asset value. Behind that, simplicity is a coordinated operating system. Orders must be received and time-stamped, securities valued, expenses accrued, cash and positions reconciled, taxes reported, and conflicts governed. In this module, we will follow that system from order entry through NAV, distributions, share classes, board oversight, and alternative pooled vehicles. The goal is not just to define a mutual fund, but to understand how its promise of fair treatment is delivered every business day. Consider an investor who submits an order at 3:58 p.m. The investor commits the money, but does not yet know the exact price. That feels unusual if you are used to buying a stock at a displayed quote. Mutual funds use forward pricing instead. An eligible order receives the next NAV calculated after the cutoff. The rule is designed to treat same-day buyers and sellers consistently, and to prevent people from trading on information that has not yet entered the fund's price. That one NAV is the visible output of a much larger process: valuation, accruals, order controls, cash reconciliation, and shareholder records. A mutual fund's NAV is basically a group project with a hard deadline, except the group includes markets, accountants, custodians, and several computers that are all completely certain they are right. This module has 4 learning goals. First, you should be able to trace a purchase or redemption from order entry through pricing and shareholder record keeping. Second, you should be able to calculate NAV and explain why fair value, accrued expenses, liabilities, and share count all matter. Third, you should be able to describe pass-through taxation, share class packaging, and the fund's virtual corporation structure. Fourth, you should be able to compare an open-end mutual fund with ETFs, closed-end funds, unit investment trusts, collective investment trusts, and private funds. By the end, you should be able to explain not only what a fund is, but how the operating promise is actually delivered. We will organize the chapter around 4 connected questions. First, how does an order become fund shares? That brings us to cutoff times, forward pricing, settlement, and the transfer agent record. Second, how is NAV produced? We will examine asset values, liabilities, accrued expenses, fair value, and shares outstanding. Third, how does value reach the investor? That includes income, capital gain distributions, reinvestment, and taxes. Fourth, how is the organization controlled? We will look at the board, the advisor, compliance, ethical standards, and alternative wrappers. These topics are linked by one durable principle: shareholders who enter, exit, or remain in the fund should be treated fairly. The phrase virtual corporation captures how a mutual fund is organized. The fund is the legal entity that owns the portfolio, issues redeemable shares, and owes duties to shareholders, but it usually does not employ a full operating staff of its own. Instead, the board contracts with specialists. The advisor researches and trades the portfolio. The transfer agent maintains shareholder accounts. The custodian safeguards assets. Fund accountants keep the books and calculate NAV. Distributors and platforms connect the fund to investors. The management company may give the product its brand, but it does not own the fund's assets. That separation is why custody, pricing, governance, and conflicts are spread across several institutions rather than concentrated in one office. Now follow a purchase order from start to finish. First, the investor submits the order through the fund, a broker, an advisor, or a retirement platform. Second, the receiving party timestamps the order and checks whether it is in good order and eligible for that day's price. Third, after the market close, the fund values securities, cash, receivables, liabilities, and accrued expenses. Fourth, the next NAV is calculated and any applicable sales charge is applied. Fifth, the investor's dollar amount is divided by the transaction price to determine the number of shares, including fractional shares. Finally, the transfer agent posts the transaction and updates the shareholder record. Several parties work at once, but the sequence matters. A weak control at any step can create pricing errors, dilution, or unequal treatment. NAV turns a portfolio into a per-share price. The formula is straightforward. Fair value of assets minus liabilities, divided by shares outstanding. In the example, $1.025 billion of assets minus $5 million of liabilities leaves $1.02 billion of net assets. Divide that by 50 million shares, and the NAV is $20.40. The arithmetic is the easy part. Every security needs a reliable value, even when a market closed earlier or a quote is stale. Expenses must be accrued before cash is paid, and the denominator must match the transfer agent record. A small input error does not stay small. It is spread across every shareholder. The formula is short. The reconciliation meeting usually is not. Forward pricing means an eligible order receives the next NAV, not the last NAV already calculated. An order received in good order before the fund's cutoff normally receives that day's next price. An order received after the cutoff normally receives the following business day's price. When an intermediary accepts orders for the fund, its timestamps and transmission controls matter just as much as the fund's own systems. Fair value can also matter when foreign markets closed hours earlier or when significant news makes a quoted price stale. The purpose is not to give investors a precise intraday quote. It is to prevent someone from using newer information against a price that has not yet caught up, which would shift value away from existing shareholders. Purchases and redemptions create a daily liquidity problem. New cash must be invested, and redemption requests must be met, without forcing remaining shareholders to absorb unreasonable costs. A cash buffer can handle routine flows, but too much cash may drag on returns. Selling securities can create bid-ask spreads, market impact, and realized gains. Some institutional redemptions may be handled in kind by transferring securities instead of cash, subject to the fund's policies. Credit lines can bridge short timing gaps, but they do not replace sound liquidity planning. Under Rule 22E4, funds must classify portfolio liquidity and manage their ability to meet redemptions. The operating question is always the same. Who should bear the cost created by a shareholder's decision to leave? Mutual funds generally use pass-through taxation. The portfolio earns dividends, interest, and realized capital gains. Expenses and realized losses reduce what is available to distribute. The fund then declares and pays distributions to shareholders, either in cash or through reinvested shares, and reports the tax character on forms such as Form 1099. In a taxable account, reinvestment does not make the distribution disappear for tax purposes. That can surprise investors because the account balance may look almost unchanged while a taxable event has occurred. A new shareholder may even receive a distribution generated largely before the purchase. It can feel like receiving a tax bill for a party that started before you arrived. The key distinction is between economic return, cash movement, and tax reporting. One portfolio can be packaged in several share classes. The underlying investments may be the same, while sales charges, distribution fees, servicing arrangements, and eligibility differ. A front-loaded class reduces the amount initially invested, although breakpoints, rights of accumulation, or letters of intent may lower the charge. Some classes combine an upfront load with lower ongoing distribution expenses. No-load, institutional, or clean classes may avoid a traditional sales charge, but the investor can still pay advisory, platform, or account-level fees. Access may depend on account type, minimum investment, retirement plan participation, or a fee-based program. Share class labels can look like alphabet soup, but the real comparison is simple. Calculate total cost for the investor's channel and expected holding period. Governance protects the fund's identity as an entity separate from its advisor. The board reviews the advisory contract, services, performance, profitability, and fee terms. Independent directors are especially important when the advisor's commercial interests may diverge from shareholder interests. The board also oversees valuation responsibilities and material risks. Under Rule 3801, the fund must maintain compliance policies, review them annually, and have a chief compliance officer who reports to the board. Codes of ethics and personal trading controls address conflicts involving access to information. Service providers must also be monitored through contracts, metrics, testing, and escalation. Delegation is necessary in a virtual corporation, but delegation is not the same as giving away responsibility. Different pooled vehicles can hold similar strategies while giving investors very different experiences. An open-end mutual fund issues and redeems shares at the next NAV, and its asset base normally expands or contracts with shareholder flows. An ETF trades on an exchange and uses a creation and redemption process. A closed-end fund generally has fixed capital and a market price that may differ from NAV. A unit investment trust typically holds a largely fixed portfolio for a finite life. A collective investment trust is maintained by a bank for eligible retirement or institutional plans. Private funds limit participation and negotiate liquidity and disclosure differently. The strategy tells you what the portfolio owns. The wrapper tells you how investors enter, exit, pay, receive information, and experience risk. The operating model has evolved through repeated fairness reforms. The Investment Company Act of 1940 established the foundation for custody, governance, disclosure, and shareholder protection. Rule 22, C1, later formalized forward pricing by requiring the next computed NAV for purchases and redemptions. By the early 1980s, 12b1 distribution financing had become an important part of share class economics. The 2003 trading scandals exposed weaknesses in order timing and stale price controls. Tailored shareholder reports adopted in 2022 aim to make fund-specific information more concise and usable. More recently, structured data, cybersecurity expectations, and faster operating cycles have raised the control standard. The durable principle is equal treatment. The technology used to deliver it keeps changing. The 2003 late trading and market timing scandal shows what happens when the formal rule and the operating reality separate. Some favored traders were allowed to place or confirm orders after the market close while still receiving the earlier NAV. Others exploited stale prices in funds holding foreign securities. Their gains came at the expense of long-term shareholders through dilution and added trading costs. The control failures included weak timestamps, exceptions, poor intermediary supervision, and inadequate escalation. The broader governance lesson is that a written policy is not enough. The organization needs data, testing, supervision, and consequences. Today, the same logic applies to digital order routing, fair value systems, and third-party platforms. Same price for everyone requires reliable clocks and controls, not merely good intentions. Use this 6-question framework whenever you analyze a fund transaction or operating exception. First, who legally owns the asset, the fund, the advisor, an intermediary, or the shareholder? Second, when did the order become valid and in good order? Third, how is the price set, including valuation sources, accruals, liabilities, and share count? Fourth, who bears the economic cost, including spreads, taxes, sales charges, operating expenses, or dilution? Fifth, who controls the risk? The board, advisor, custodian, transfer agent, or intermediary? Finally, what evidence supports the conclusion? Look for confirmations, prospectus language, policies, reconciliations, and exception reports. These questions turn a transaction that looks simple on the account statement into a disciplined control analysis. Apply the framework to this mini case. An investor submits a $25,000 purchase through an authorized retirement platform at 3:59 p.m. Eastern. The platform batches the file and sends it to the fund after 4 SARD. 2 days later, the fund declares a large capital gain distribution, and the investor believes the fund charged tax immediately. Assume the order was received before the cutoff and was in good order. Which NAV should apply, and what timestamp evidence would prove it? How should the transfer agent calculate the shares credited? Why might a taxable investor receive a distribution generated before the purchase? And what explanation could prevent the investor from confusing fair execution with tax timing? Pause here and prepare a recommendation, one calculation, one risk, and one additional fact you would request. Pause the presentation and answer these 4 questions before continuing. First, why does a mutual fund use forward pricing? Second, Which party maintains the shareholder account record? Third, what can make two share classes of the same fund produce different investor returns? Fourth, why can a taxable investor owe tax on a distribution that was automatically reinvested? When you are ready, check your reasoning. The answers are: forward pricing applies the next computed NAV consistently and limits preferential use of stale information. The transfer agent maintains the shareholder register and processes account-level transactions. Share classes may hold the same portfolio but have different expense and sales charge structures, and a pass-through distribution can remain taxable even when it is reinvested in additional shares. Carry forward 6 ideas. First, forward pricing values fairness more than intraday price certainty. Second, NAV is a system output. Valuation, accruals, liabilities, and share records must reconcile. Third, the fund is legally separate from the management company, and the assets belong to the fund for its shareholders. Fourth, income and realized gains can pass through even when cash is reinvested. Fifth, share classes and legal wrappers can change investor economics without changing the underlying strategy. Sixth, trust is created through boards, compliance programs, intermediaries, and service providers that make equal treatment operational. The NAV formula fits on one line. The closing control checklist does not, and that is exactly the point. The source page is the refresh register for Chapter 2. Posen and Hamacher provide the operating architecture, while the SEC, FINRA, the IRS, the OCC, and the Investment Company Institute provide current rules, investor guidance, and industry data. These sources should be reviewed before each new course offering because reporting formats, regulatory deadlines, and product practices can change. The next module turns from how a fund operates to how investors and professionals research what the fund is designed to do,